the webinar for today is optimization for real estate investors. We're going to focus on leveraging what's called accelerated depreciation to maximize your cash flow. And I'm honored to have two colleagues and experts in the field helping today with teaching this topic. So to start, our company, Magnify Real Estate, is a real estate tech investing and brokerage company. We offer end-to-end services for clients to help build their cash flow and their portfolio. We are focused in California, in the Bay Area. We've got over 600 million of transaction volume that we've done. And we have an executive team with experience from Harvard, MIT, Colliers, Marcus & Millichap. And at the end of the day, we started a family company. So it's myself and my two brothers, and couldn't be more honored to be working with them. Now, in terms of my background, I started as a real estate agent in 2011. So I've been in this for 13 years. I started investing in 2016, and I didn't know about accelerated depreciation, or I should say I didn't apply accelerated depreciation to my own investment portfolio until about, Kim, do you remember? I think it was 2022. I think was the first year that we did it, maybe 22 or 23.
Yeah.
So there was probably 6 or so years that I wasn't taking advantage of this benefit, even though I was a real estate professional and even though I knew about the benefits. So I think this is an opportunity for the attendees to ask their questions and get over the hump of knowing and get into the doing phase of things. I'm generally really passionate about real estate. It's kind of the only career I've ever had. And I'm also really passionate about not paying any more taxes than you really legally need to or have to. And so with that, we'll get into the profile of our next guest, which is Jonathan. Jonathan, tell us about yourself.
Thank you. Good evening, everyone. And thank you, Eric and Kim, for having me on the panel. My name is Jonathan Baughman. I'm president of Exchange Solutions. And Exchange Solutions is an independent 1031 exchange accommodator. We're based out of the Bay Area, San Jose. We've been in business for close to about 30 years in total, and I've been doing exchanges here for about the last 20 years. We accommodate exchanges all over the United States. We handle both residential and commercial properties, regardless of their size or value, and I'm very passionate about helping people not pay taxes. So I'm happy to, again, happy to be on this panel and share how this all interacts with Section 1031.
Awesome, thank you. All right, and tell us about yourself, Kim.
Yeah, thanks, Eric, for having me on the show. Thanks for everyone joining. I appreciate it. I know it's late in some places. So my name is Kim.
Yeah, thank you, Kim. You're coming from the East Coast, right? It's like 8 o'clock for you. So thank you.
I'm the Executive Vice President of Engineer Tax Services. We are a full service specialty tax firm. So we do not file tax returns. We do specialty background like the cost segregation studies that we'll be talking about today, research and development tax credits, and certifications in energy. So like the 179D, 45L, those types of things. And I have been a real estate investor proudly since the late 90s. And I also have a passion in real estate, as well as saving on taxes. So we have a model that we'll share a little bit later in the slides that is kind of fun. But yeah, I've been doing this for about 15 years at Engineered Tax Services. Before that, I was an entrepreneur. And I'm also currently on the tax and the sustainability committees for the Real Estate Roundtable in Washington, D.C. So we have a lot of power in that. That's the largest lobbying group in the country. So I'm part of that. I'm proud of that. So yeah, I'm happy to be here and happy to share with you what we've learned.
Amazing. All right, cool. So I'd like to get into kind of the basics of what we'll cover today. So, and pardon me if I'm kind of a little bit stuttery or staccato. There's a lot of people that are flooding in and I have to click admit for each one. So that's what's going on in the background. So what we're covering today, we just went through the introductions. Then what we're going to do is understanding accelerated depreciation. What is it? What are the basics? We're going to compare this traditional versus accelerated depreciation. Then we're going to talk about the advantages and drawbacks. So I'll do those sections. Then we're going to pass the mic to Kim, or actually to Jonathan. He's going to talk about 1031 exchange implications, how accelerated depreciation is impacted if you are doing a 1031 exchange and doing a study. And then Kim's going to walk through the full breakdown of the cost segregation, or cost seg for short, exploring different methods, talk about partial asset disposition, bonus depreciation, some kind of fancy, advanced real estate techniques, and then a couple of case studies. We will leave, as I said, about 20 minutes in the end for question and answer. So please save your questions until that time. Basically, accelerated depreciation isn't all that fancy or difficult. It's just a tax strategy used by real estate investors to speed up or accelerate the recovery of the costs for tax benefits. So there are traditional methods of depreciation. That's what's called the standard that we'll get into in a moment. But accelerated depreciation tries to take as much of it up front and get the tax benefit today instead of in 5 or 10 years' time. And the goal ultimately is increase your cash flow, increase your return on the investment. Now, there are some nuances, so that's why we have experts like Jonathan and Kim to walk us through this. It's not something that you would probably want to do yourself in terms of a study. There's a lot of risk associated with that. So I full disclaimer, have used both Jonathan and Kim, their companies, I should say, for my own portfolio. I trust them intrinsically, and that's why we invited them to speak on this panel. So traditional versus accelerated, by maybe a show of hands, how many people in the webinar have done an accelerated depreciation study? Or maybe you could just in the chat box, mention if you have done an accelerated depreciation study on one of your portfolio properties. Looks like a few people have. So basically, traditional depreciation spreads the depreciation evenly over the useful life of the property. Typically for a multifamily property, that's 27.5 years. For commercial properties, you might have longer time frames, but it's spread evenly. It's divided by 27.5 in this case. You get a consistent deduction each year, and it provides kind of a slow tax benefit. Whereas the accelerated depreciation allows for much larger deductions in the early years of ownership. It front loads the depreciation expense and accelerates the tax benefits. So, common methods, there's something called MACRS, it's an accounting term, or bonus depreciation, or cost segregation. These are all, various terminologies that we'll get familiar with. One thing that I want to point out is that you're not actually getting any additional depreciation. So if you were to hold the building for 27.5 years, your straight line depreciation method would result in the exact same amount of depreciation as an accelerated depreciation study, and then 27.5 years of ownership. So it's the same amount, but you can kind of redistribute or rebalance. So in terms of advantages, it definitely increases cash flow. In my own portfolio, using accelerated depreciation allowed me to have a larger deduction in the early years of my ownership. And it resulted in enhanced cash flow because I didn't have to pay as much income taxes on the cash flow from the properties. It also led to tax savings because by front loading the depreciation, I have less taxable income. It can, Kim may be able to get into this, but you can actually use it to offset different types of income and lead to lower tax liabilities overall. So, something Kim and I have worked on is that, wow, there's a lot of people flooding in. This is good. We got a lot of people in the webinar. What Kim and I have worked on is actually using accelerated depreciation studies to offset my income as a real estate professional. So if any of you are real estate professionals or have thought about that, that can be a really savvy thing that we can walk you through privately. And then ultimately improving your return on investment, or ROI. So accelerated depreciation strategies maximize the return on investment by increasing your cash flow and reducing your tax burdens. Now, what goes up must come down. What has benefits also has drawbacks. So one of the drawbacks is that there is what's called a recapture tax. So if a property is sold for a gain or a profit before the end of its what's called useful life, or the time that you're putting it into service, let's in this case call it 27.5 years, the accelerated depreciation may trigger what's called a recapture tax. So you may have to repay some of the previously claimed deductions. The idea is, hey, if you were taking this, accelerated depreciation up front, and then you sold it in, let's say, 2 years, you may have to actually repay some of that benefit that you claimed. And CPAs and Kim's company can help to actually do those calculations if you're in a position where you need to do that calculation. But generally, it can be complex if you make the mistake I did, which is you buy a property, you do a study on it, you sell it a year later, and then you're rolling that basis forward, and you got a lot of CPA work to do. Now, in terms of complexity, it is a study. There is a cost involved. There's some understanding of what you're buying that is important so that you can confidently explain it to your CPA if they're not familiar with it, and just know for yourself what it is that you're doing. And then there's future tax implications. So if you front load the depreciation, you'll have lower deductions in future years. So you may have a higher tax liability down the road. And we'll get into the details of how that would work, how it looked in my own portfolio. So that's kind of an overview of the straight line depreciation versus accelerated, and the advantages and drawbacks of the accelerated depreciation method. Okay. So, Jonathan, can you tell us a little bit about the implications of accelerated depreciation on 1031 exchanges? Maybe touch on some of the points here and some of your experience with, how a 1031 can make this a little more complex.
Yeah, absolutely. So, when we talk about depreciation, of course, in 1031 exchanges, we need to talk about that depreciation recapture that you touched on. Avoiding the recapture along, of course, with, gains attributed to appreciation, that's normally the benefit of doing a like-kind exchange. But the Section 1245 property can have the effect of basically, requiring recapture of a portion of what would normally be deferred gain in an exchange. So what I mean by that, the IRS has a rule. It's called the incidental personal property 15% rule. It's a mouthful, but basically what it means is the IRS, if there's incidental personal property included with the sale of a property, and as long as it's not more than 15% of the value of that replacement property, then you don't have to worry about it being, classified as personal property and not being exchangeable. It's just basically grouped together with the real property. So when we talk about, maybe doing a cost segregation study, getting some accelerated depreciation, then we are basically taking out some of that personal property and reclassifying it, getting that additional, depreciation on it. So really, it begs the question then, number one, what are the effects of that? And there's two effects really. Number one thing that, we should know is that people will say, okay, I'm going to be doing an exchange. I'm going to be buying a property. I want to do a cost segregation study on it. How does that affect my exchange? The bottom line to that is it does not affect your exchange. If you do an exchange, you buy a new property, you do a cost segregation study on it, it does not affect your exchange. What does affect your exchange is exchanging out of a property that you had done a cost segregation study on. And there's two effects that can happen when you do that. So the first is that if there's significant personal property on the depreciation schedule at the time of the sale, then you would need to acquire a replacement property that has an equal or greater amount of similar personal property on it. Okay.
And Jonathan, just to clarify, when you say personal property, you're not referring to, a wheelbarrow. You're considering like the kitchens and the bathrooms to be personal property. Am I understanding that correctly?
Correct. Yes, exactly.
Okay.
So, typical
Go ahead,
personal
Kim.
property, they would talk about, flooring, cabinetry, countertops, partitions, things of that nature. So, and that's just a few examples, but there's much more than that. So when we do this reclassification and we speed up the depreciation on those types of assets, and you're doing an exchange, then it's important on the new property that you're going to have an equal or greater amount of similar property. And how are you going to know that? Well, then generally the answer to that is you would need to do a cost segregation study on the new property or look for a property that had one done on it. Because if there's a delta, then that's where you run into issues and you could have a tax liability because you're not taking on as much personal property as you did previously. So that's one concern that happens. The second problem that can arise is that if the building improvements, you do the cost segregation study, and those improvements are again reclassified, and then you sell the property's gone up in value, maybe the personal property items have gone up in value as well, then you could trigger recapture, which would be taxed as ordinary income. So that's something to keep in mind as well, that you could be faced with. So really, the problems can be twofold. But again, this really only comes into play if you're selling a property that had a depreciation study done on it. If you're selling a property that did not have one, and you just exchange into a new property, whether or not you do a depreciation study on that, you'll be unaffected.
And what about the tax basis? Because when we worked together on my portfolio, my understanding was that my tax basis for the property actually got, I think, reduced would be the right word. How does doing multiple 1031 exchanges impact your property tax basis?
Well, yeah, in terms of
the cost. Sorry, to clarify, the cost basis, not the property tax basis. I apologize. The cost basis.
Yeah, so that's one thing to know. When you keep doing exchanges over and over, the gain that you have is just a tax deferral. So the gain's not going away. So you do an exchange, your gain gets deferred. Your basis in the new property is simply going to be what you're paying for it minus the gain that you're deferring. So you do the exchange, you defer the gain. Your basis is not the value of the new property. It's the value minus the gain you deferred. And then maybe you do another exchange and then you buy another replacement property. Again, you're simply carrying over the prior bases from the prior relinquished properties. So that's something to bear in mind as well. You do the exchange, you buy a property, you think that basis might go away. It does not. It does follow you into the new property or subsequent properties. And there's no limitation on how many exchanges you can do. So you can keep deferring it over and over and exchange. But ultimately that basis does not magically get wiped away unless, maybe you pass the property down through your estate to your heirs, that type of thing. But in general, it does not, other than that, it does not get wiped away.
Right. And that's actually my strategy for my own portfolio is, as morbid as it is to talk about death, I just do 1031 exchanges with Jonathan's company. I do accelerated depreciation with Kim's company. I'm getting the tax benefits now. I'm deferring paying any property tax capital gains. I'm deferring paying any capital gains. And then my plan is that I'll just gift the assets to my heirs when I pass away and get a clean slate, unless anything changes in the tax law between now and hopefully 100 years from now. I just get a clean slate on all of those capital gains that I had deferred. They get wiped out and my heirs get a new basis. And so I complete the loop. And that's kind of my personal strategy.
Yeah. Swap till you drop is the term they coined for that.
Cool. So now let's pass the mic to Kim. And Kim, maybe you can get in kind of the nuts and bolts. Tell me as you'd like the slides to advance, but basically get into the nuts and bolts of kind of how cost segregation works.
Yeah, so I appreciate that. The cost segregation, essentially, like you had mentioned, if you don't do a cost segregation study, you're depreciating that asset. If it's multifamily, it's over 27.5 years. If it's commercial property, it's over 39 years. The only exception to that is if it's a short-term rental, if it's a home or it's a single-family home and a short-term rental, the IRS does view that as a transient property like a hotel, so you have to depreciate that over 39 years as well. So it's 39 years or 27 and a half. So we'll talk about when we're talking about long-term assets in this discussion, we're referring to either 27 and a half or 39 years. Okay, just so everyone is clear with that. Essentially, when you're doing a straight line depreciation, as you mentioned earlier, you are depreciating it either over 27 and a half or 39 years, and that's called straight line depreciation. It's very, very static. So it's kind of the difference between filing filing with your standard deductions or filing with your itemized deductions. Okay. So if you file with your standard deductions, you're just getting that deduction and you're not itemizing anything. If you itemize, you actually get to take more deductions, but you have to itemize. And what we're doing in this property when we're doing a cost seg study is we're itemizing the assets so that you're not having to depreciate or under the standard. Okay. So you're actually itemizing the property itself. And there's a pretty good slide in here later that will depict that in a picture. So essentially what we're doing in a cost segmentation study or a cost segregation study is we're segmenting out the assets of that property. And so instead of depreciating the entire asset in one, we're actually breaking down all the different assets in the property and moving them into different recoverable periods. So for instance, finishes, specialty electrical, mechanical, plumbing, flooring, carpeting, cabinets, paint. Paint is usually a long-term asset because it goes with the walls, but all of the other things of flooring, specialty electrical, that all would go into like a 5-year bucket. Okay. And then I want to clarify something that even though that is classified as personal property, it's actually not personal property like you would think, like a computer or furniture or a vehicle would be personal property. This property is installed in the property and it's actually considered 1245 property. 1245 property is a tax term that we use. 1250 property would be real property, which is the structure. 1245 property are all the finishes that go into that, or the landscaping, that like site improvements, things like that. The site improvements would be landscaping, parking lots, irrigation, fencing, signage, that stuff. That would go into a 15-year classification. Okay, so there's different buckets or different recoverable periods that we will shift the long term from 39 or 27 and a half into these faster buckets, which gives us more depreciation. When we're doing these types of things, this does not trigger you to now have to pay property tax on the 1245 property because it's not personal property. It's 1245 property installed in the property. It's important to note that because there is some confusion out there, especially when it comes to 1031 exchanges, that you may end up having to extract and not include the 1245 property. That is not the case, and it has been corrected by the IRS. There was a lot of confusion on that when it first came out, but it essentially, let's say if you're buying a hotel, for instance, and you're buying a bunch of furniture with that hotel, you have to extract out the furniture, right? That's personal property, or called FF&E, furniture, fixtures, and equipment. That has to be extracted. But the 1245 property is not the same classification. So it is different, even though it's still a 5-year asset. So I want to clear that up because I think it's really important for this discussion, especially going forward. So as we're going forward, just the overview of a cost seg, essentially we're just pulling assets and we're reclassifying them, individual assets, into different class lights or shorter recovery times. So if you want to go to the next slide.
Yeah.
This is a kind of a picture that I was telling you about. Instead of depreciating as one whole building, essentially we're going to be breaking down each of the assets within the property. Next slide. So a good candidate for cost seg study is really anyone who owns investment property or income producing property. This could be short-term rentals, long-term rentals, single-family homes, all the way up to multi-family homes, all the way up to trophy buildings, in Chicago, Atlanta, San Francisco. So if you own a commercial or investment property, you would be a candidate for a cost seg. Now, the utilization might be a different topic, right? Can you utilize the deductions if you're passive or if you're active? And the answer is yes. It just depends on which level. and where it's going to go in your return. So that's when it takes a good conversation with your CPA to understand. Anyone who has a depreciable basis of $50,000 or more, I mean, that is a really, really low number. So that's why it really makes a good candidate for these, is because really anything would make sense. Even if you don't own the building, if you own leasehold improvements and those improvements are being depreciated over a long-term asset, we can do a study on those assets only, even if you don't own the building, because you do own the improvements. Anyone who's paying federal income tax, right? So if they own real estate, they're paying federal income tax, they would be a good candidate for CAS-SEG. A for-profit entity, obviously, if you're not for profit, you're not going to be paying much tax, so you wouldn't want to be looking at a CAS-SEG study. And then this might surprise most of you, that if you plan to hold a property for more than 1 year, it is a good candidate for CAS-SEG. Trust me when I tell you, I've heard everything you could possibly hear about excuses as to why CAS-SEG may not be a good idea. And I can help you with all of those. So there are reasons why, even if you hold the property for 2 years, why it would make sense to do a CAS-SEG study for different reasons. It's not for everyone. But there are reasons why it could be a good candidate, and we'll get into that when we start talking about improvements. Next slide.
Yeah, very, very interesting. I personally came to Kim's company because I was paying large federal income tax, and I went from having to pay, a large sum to literally paying zero and getting a big refund check just because of this study. And so the power
years, that's not just 1 year, right, Eric? That was over multiple years that minimized taxes or eliminated them.
Right. Very powerful strategy here.
The types of properties. This would be any new construction, existing properties. So even properties that you've owned for 4 or 5 years, we can still go back and do a CAS-SEG study. We don't have to amend your tax return. We can do what's called a Form 3115. That is a reconciliation, and Eric is familiar with those because we had to do that when he first met me. We had to go back and kind of reclaim. It prevents you from having to file an amended return, so it allows you to bring the old depreciation into the current tax year. So older properties, existing properties, new purchases would be a good candidate. Anytime you're doing substantial renovations, 50,000 or more, leasehold improvements, 50,000 or more, a step up in basis, like Eric was talking about, is when he passes his property on to his children, or through the trust or whatnot, there becomes an inheritance. There is a step up in basis. That would be a great time, because that step up in basis is equal to the fair market value at the time of the inheritance. And so we can do a CAS-SEG study to help minimize the inheritance there, or that tax that they are incurring. And then 1031 exchanges are a great opportunity. We are allowed to apply cost segregation to the excess basis. So as Jonathan was saying, when you do a 1031 exchange, you're purchasing a property, but you're reducing that basis. Your depreciable basis is reduced by the capital gains that you're rolling into that deal. So if you buy a property for $1 million and you bring in $200,000 of exchange money, your new basis is going to be, give or take, $800,000. And that's where your depreciation starts. We can start a depreciation schedule over again, and we can match up those 5 and 15-year properties from the old or the relinquished property going into a replacement property.
Yep.
Next slide. There's a ton of myths about cost segregation and why it may not be good for you, right? And there are some cases where it may not be good for you. But these are all the cases where it's actually really beneficial, and it's not just the time value of money. There are so many different benefits to this. Personally, I had mentioned that I've been investing in real estate since the late 90s. I have a very, very nice portfolio I've built for myself over the years, mostly in real estate. I have this love of real estate. I'm a deal junkie. I'm sure that a lot of you on this call can relate. If it's been out there, I've probably had something to do with at some point in time owning something like that, or very close to, and had dealt with, whether it's 1031 exchanges, swap and drop and swaps, call it whatever you want to, but I've probably been engaged in that. So that's one part of where my passion comes from is actually living through some of these myths. Next slide.
And could you speak maybe just for a minute for my own knowledge, what is the reduced liability insurance premiums?
Yeah, that's great. We're the only one in the industry that does a DERA report. A DERA report is a detailed insurance engineered replacement appraisal. And so essentially that DERA report will, because we're providing a replacement cost, we're rebuilding that building on paper from the ground up using construction software. That's how we're able to get all the assets. And when I talk about assets, I'm talking about every copper elbow in the plumbing behind the wall. I'm talking about the light switch plate covers. I'm talking about every Ethernet outlet. I'm talking about every single ounce of anything in that property we're breaking out, and Eric can attest to that in our detailed reports. When we're rebuilding that building and we're saying, hey, if we're going to rebuild this building today and today's value, what would that cost? You now have the ability to take that replacement cost to your insurance company and say, this is what the value of it would be for insurance purposes. Insurance companies don't want you to know that there are certain assets that in that building that are not covered under insurance. Like your foundation, for instance, will never be covered under insurance. The utilities under the ground, they'll never be covered under insurance. So you need to extract the value of the foundation and those utilities under the ground from the value or the total replacement cost, not just the land, because you don't want to pay tax or pay insurance on certain assets that aren't even ever going to be recovered. So you want to delineate that and know what that is. So on average, our reports, because we give you a DERA report, that will actually give you the replacement cost that you could take to your insurance company and say, this is a certified engineered based study that proves that, you know, you can reduce my replacement cost and I'm only paying premiums on that. The higher that replacement cost is, the more premiums you pay. So this is a perfect example of doing a cost seg study and as a result of that. So we include those in all of our reports as well.
Wow, that's fascinating. I have some homework to do. I got to take my studies to my insurance companies. I learned something new tonight too.
Yes, let me know, Eric. We'll go over them, but there is a page buried in the report. It is an insurance replacement. There is a heading page for it, but it's under the engineering pages, so we can go through that and I'll show you where those are.
Cool, thank you.
So this slide is very indicative of, you know, kind of the benefit. One of the myths that I hear all the time, and I've been doing this for a long time, you guys, you know, and kind of live and breathe this in my, you know, my personal portfolio as well as, you know, for work. But this yellow line at the bottom, this is your straight line depreciation, right? That is your static depreciation, you know, $100,000 a year for 39 years or whatever that is on this property. Obviously that's a very large property, but, you know, put it into perspective. And you're just getting your standard depreciation, right? Straight line depreciation, no fluctuation to it. When you do a cost seg study, a lot of times I hear that, yeah, you're going to take all your depreciation up front, then you won't have any depreciation left, right, to take in future years, which Eric knows that and we have taken that myth and debunked it. This is a perfect example. What you're looking at here is the dark blue line is when you do a cost seg study, you, instead of taking $100,000 a year, you're taking $600,000 a year for the first year, and then it begins to drop off. And this is like where that bends down at the top. That's your 5-year mark where it drops down. And between year 6 and 15 is that next tranche where it goes and then it drops down just a little bit more. At the bottom, right there, that's your 15-year bucket. Now, if you look at this, that might be, you know, in year 6 through 15, you're getting maybe $90,000 of depreciation, right? And maybe in year 16 through the remainder of it, you're getting about $80,000 in depreciation. But that's such a small amount compared to what you would be getting if it's straight line, but you're going to take this big, huge jump up front. Because of that depreciation, you're reclassifying the assets. So don't let anybody tell you that you're taking all the depreciation up front. The only time that is the case, that you're taking all your depreciation up front, is if you do a cost seg study on a car wash or a gas station. Those have special rules, and you are able to take the majority of it, and you get 100% bonus, which we don't get right now. So there's very, very few options that it would give you the ability to take all your depreciation up front and have no more depreciation the rest of the time. So next slide, please.
Yep. Let's see this way.
Yeah. So the MACRS methodology is the what's called the modified accelerated cost recovery system. Please don't memorize that. It doesn't matter. The MACRS methodology is in lieu of your straight line depreciation. You do straight line depreciation is your standard. MACRS is the itemized. So we're actually itemizing the assets and we're taking it. So it's just a different method for depreciation. The IRS has given us this method. It's dated back to the 1940s. This is not a new strategy. This strategy has been around for years and years and years, and our real estate pioneers have paved the way for us to be able to take an alternative method of depreciation. The reason the IRS allows us to accelerate the depreciation on certain assets is because those assets are not designed to last any longer than that. Carpeting, for instance, how many times are you going to replace carpet? Every 5 years, right? 5 to 7 years. You do not want to depreciate your carpet over 39 years. That's just asinine. So we want to make sure that we are depreciating it under those last class lives that make it more appropriate. And as a matter of fact, the IRS writes out it's called an audit technique guideline. Okay, they write a guideline for their auditors to review when they're doing an audit with a cost seg study. Okay, and in this audit technique guideline written by the IRS, it says that the preferred method for depreciation is the MACRS. And the reason for that is because it is much more substantive and it's much more aligned with what's actually going on in the property. If you're depreciating your carpet over 5 years, it should only be depreciated for 5 years because chances are you're going to replace it in that time period. Okay. So this is the preferred method of the IRS, and we're here to substantiate that. So we'll skip down to the next slide if we can. Essentially, I want to talk about partial asset disposition for a minute, because this is a huge, huge benefit that a lot of people don't realize is there for when you do, improvements on a property. Okay. Traditionally speaking, when you buy a property, you're going to depreciate that over 27.5 or 39 years. Okay. It was straight line depreciation. And let's just say hypothetically that you replace the roof of that property. Okay, let's say it's a multifamily, replace the roof, you spend $100,000 or whatever it is. What happens traditionally is that roof is required to be capitalized. You now have to take that $100,000 and depreciate that over 27.5 years. Okay, you don't get it as an expense because it's a replacement. And so the IRS makes us capitalize that roof. Well, guess what, you guys? Now you're depreciating 2 roofs. One that came with your purchase that you're still depreciating over 27.5 years. And now in year 2, you're depreciating your second roof. And now you're depreciating 2 roofs, one of which doesn't exist. That's called a ghost asset. Okay. What we want to do, and what you can do as a result of doing a cost seg study, is you break down all the assets, including the roof, right? And then once you replace that roof, now you've created this cost seg study becomes like a Bible for your building. Okay, as you have this Bible and you've got all of the assets delineated in it, and you have the actual cost of that roof when you bought the property, and now you replace the roof. A result, what you should do, and what the IRS tells us that we need to do, is we need to remove the remaining depreciation of the old roof. But guys, when you're depreciating this stuff over straight line depreciation, how are you supposed to know what the value of that first roof was if you just bought the property and say it was 20 years old? You can't. It's very difficult, if not impossible, unless you have a cost seg study. So you do the cost seg study to create that baseline, get the dollar amounts for everything. Then when you do the improvements and the replacements and all of this other stuff, you create what's called partial asset disposition. So we capitalize the roof or whatever else must be capitalized in the improvements. At the same time that we do the cost seg study for the roof, we go in or we give your CP the ability to now take the partial asset disposition and remove the remaining depreciation from the old roof. So if you have a roof and you've owned that property for 2 years, but it's a 20-year-old roof, we do put in a condition factor for that, by the way. But we want to make sure that we're taking off the remainder 25.5 years of depreciation. Okay, get that off the books, take an expense for that, and get that additional deduction. This is where cost seg studies will pay you back year over year over year. It's not just the benefit of the first year, okay? So partial asset disposition is extremely beneficial and should be utilized at all times when you're doing, do the cost seg study, and then we do an improvement study, or at least at minimum, you have the baseline to show what the remaining depreciation is for those other assets. Okay, next slide. I know we're running out of time and I want to get through this. We're going to talk about bonus depreciation briefly, but let's go to the next slide because I think that one would be better. Okay. So the bonus depreciation is very, 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 very interesting and extremely powerful. Okay. Now, bonus depreciation started in 2017. Okay. Sorry, let me take that back. 100% bonus depreciation started in 2017. But bonus depreciation, it has actually been around since 2006. This is a bipartisan bill. This is something that, lawmakers will use to turn it on or turn it off to help incentivize us real estate investors to, or anyone really for that matter, who's purchasing property or purchasing assets, okay, that have to be depreciated. And what this is, we had talked all along the way that we're moving assets from a long-term to a short-term bucket, to a shorter-term bucket, like your 5-year or your 15-year, okay? So now what happens, instead of depreciating it over 27.5 years like Eric was doing before, he now has 3 buckets, okay? So on your depreciation schedule, you might see a building and then land, and that's it. Building for 27.5 years, or long-term asset, and then land. And that's how it's broken out most of the time. When you do a cost seg study, all you're doing is adding 2 more buckets. Okay, you're going to have building, which is your long-term asset, 27.5. You're going to have now your 5-year asset, and which is your 1245 property, and your 15-year asset, which we had talked about those assets going into those buckets. So that's it. We give you your CPA report that shows those class lives. Now, here's where it gets really, really interesting, guys. Instead of depreciating those assets over 5 years or 15 years respectively, okay, there is a bonus. There's an extra. It's not any more depreciation than you would normally get, but what the IRS is saying is that if you are eligible for bonus depreciation, instead of depreciating that asset over 5 years or 15 years, anything that's put into a bucket that's 20 years or less now gets depreciated 100% upfront. You don't have to wait 5 or 15 years for it. You get it right now. Folks, I'm telling you right now that this is no joke. If you are in real estate and you are not doing cost segregation, you are absolutely missing the boat, regardless of the reason. I will tell you that because this becomes extremely powerful. I myself have been able to take my own portfolio. I have multiplied it tenfold just because of bonus depreciation. I've been able to take the write-offs, and I want to get to the case studies that Eric has in here because I think it's very powerful, where he's been able to take millions and millions of dollars, reinvest that into additional real estate because he was able to take the bonus depreciation on some of the projects that he did as a result of the cost seg study. Now, bonus depreciation is a little bit elaborate. It is starting to sunset. The 2023, instead of getting 100% bonus, that means 80% of those 5 and 15-year buckets you get in year 1. The remainder of the 20% gets allocated between its respective 5 and 15-year bucket. Same thing in 24. So right now we're in 24. Right now there's 60%. You get 60% up front. 40% gets allocated between its respective 5 and 15-year buckets, and it continues to deteriorate until 2027. There's nothing left. But there is a bill right now, folks, right now there is a bill to bring the 100% bonus depreciation back through 2025, okay? And if that happens, it's going to reinfuse real estate, and it's going to help. That, coupled with the interest rates being reduced 6 times this year that they're announcing, those 2 things are very, very powerful. So go ahead, Eric, to the next slide, and we'll try and get through the rest of this. Let's go to the next slide. I don't want to take up too much of your time. I know that we're supposed to end and have questions here. Case study, okay? Instead of these, Eric, can you go to yours and we'll just give him some
Yeah,
real,
absolutely.
I mean, these are all real examples, but this is very personal to Eric, and he's been generous enough to be able to put this in. These are actual properties that he purchased, multifamily properties. And what he's done here is shown without cost segregation, this is what his straight line depreciation would have been. Now you notice the 14 units in Oakland, the second one, that bonus, that depreciation would have been about $3,000. And that's probably because he bought that on December 31st, I would imagine, or very, very close to the end of the year, because your first year is always prorated when you do straight line depreciation. But as a result of doing a cost seg study, and because he was eligible for bonus depreciation, he was able to turn these numbers into massive numbers and be able to offset his tax liability from here. So this has created a deduction for him of over $2.3 million in 1 year that he was able to do these studies, okay? Now, this is powerful because when you 2.3 million times your tax rate, okay, 33%, whatever, call it a, $750,000 a cash. If you can utilize it, that's a tax savings that you can literally reinfuse. He can take that money and put that back into improvements in the property. He saves that. Now what happens is it's more than just the time value of money, because you reinfuse the improvements. Those improvements end up increasing rents naturally, right? So now he can turn that money into making more money for himself, or buy another property, which is exactly what he and his brothers have done. So I think this is compelling. And, yes, there are some caveats in here, but I encourage you to bring up what those caveats might be, even in the event of recapture. If you buy a property and you need to sell it in a couple of years and you might have some recapture tax to pay, you have to remember that if you do a 1031 exchange, you're just rolling that into the new property. You're not having to pay that back. You get to keep those tax deductions, okay? So anyways, one more slide, Eric, and we'll see where we come up with on the questions.
Yeah, for sure. And I just want to highlight that this benefit of $2.3 million, I was blown away to learn that it rolls into future years if it's untapped. So I think in the first year, out of 2.3 million, I tapped into 500 or 600K that I needed to wipe out my income taxes to absolutely nothing. And then I still had 1.8 million for all these years going forward. So I have this huge piggy bank of write-offs, so to speak, going into this next tax year. And I've just been blown away by how powerful it was as a strategy.
Yeah, if you can't use the tax deductions in that year, in fact, most of my investors can't. You use what you can, and then you roll over the remainder to the following year. And here's the kicker: even if you're a passive investor, okay, and you can only offset your passive income from this, it's still beneficial, because if and when you can bank up all these losses and offsets all of your passive income as long as you own it. But then when you sell that property, guess what? All of those losses get converted to active. So you get to offset your W-2 wages or your ordinary income. My gosh, you guys, powerful tool. Now, we believe that everyone should pay tax, but there is nothing in the code that says you have to leave a tip. And we are in the business of taking the tip off the table, and so is Jonathan. That's why we're here tonight, is to share these strategies with you, not only just because this is what we do, but this is what we live and breathe every single day. Okay, we're doing this, we're living it, we're breathing it in our own portfolios. So I guess now we can open up to some questions, right?
Yeah, absolutely. Thank you both. I just want to highlight that our website is a powerful tool for investors. We've built it from the ground up, so you can go to magnifyequity.com. I think that's right here on the bottom, magnifyequity.com. We'll be sharing these slides out in the recording, and a link where you could book a call with Kim, Jonathan, myself. And at this time, we really just want to open the floor to questions and answers, and give you guys an opportunity to talk through some of the specific situations that you may be going through. But first off, let's give a round of applause to Jonathan and Kim. Thank you all for joining us on this webinar. I couldn't do it without both of you.
Thank you very much.
So I have a couple of questions in the chat that I'll start with, and then people are welcome to raise their hand in Zoom if they have a question, or type it into the chat, and I'll speak it to the group. So Will Tharp asked if you can switch to a cost segregation if you're already doing straight line depreciation for a period of time, but you still have value left to depreciate. So his question is, when would you not be able to do a study to utilize cost segregation? Or if you're already doing straight line, can you switch to cost segregation? Kim, I think that's an easy one for you.
Yeah, it's easy. And Eric, you've done this. So you were depreciating your properties on straight line, and we were able to come back and switch you back over to the MACRS methodology by doing a cost seg. It's really never too late. I typically have a rule of thumb that if your asset that you've owned it for, if you've owned it for more than 15 years, it's not a hardline rule because there are some exceptions to that rule. But if it's over 15 years, it doesn't make a lot of sense unless there's a specific purpose. So yeah, easy. You could go back and reclaim that depreciation. And you do not have to file an amended return to do this. So even if it's 4 years ago and you can't file an amended return, you can still do a cost study and bring those deductions forward to the current tax year using that special form that I was telling you about.
Awesome. So another question from R. Durrell Patrick said, how far forward or backward can a taxpayer carry the deductions?
Yeah, that's a great question too. I don't want to confuse you with the statistics, but you used to be able to carry back some of these deductions a couple years, but they turned that off. And now essentially, you can't go backwards with them unless you file an amended return, which you could do if you wanted to, but only the last 3 years, right? So you have choices. If you do a cost study, you have to run the numbers and see, will this benefit me to amend my tax return the last 2 years and get a refund, or last year to get a refund? Or should I just bring these deductions moving forward and bring them into my current tax year? Now, if you can't use the deductions, like we talked about, they will roll forward indefinitely as long as you own that property. And then, of course, when you sell the property, if they are locked up in passive losses or something like that, they do convert to active, which is very, very beneficial. I have multiple examples of how I've used this. Oh boy, was it fun. But I won't be able to share those today. So you're going to have to pick my brain or have me back another day.
Awesome. Vincent Vasquez asked, if he never sells his fourplex, will there be recapture costs that spring up on him?
There's always going to be recapture costs when you sell a property. It depends on where they're at. If it's all your real property, then you're paying a capital gains and a recapture at the capital gains rate, which, by the way, you do a cost seg study, you get to take the deductions at ordinary tax rates. When you sell the property, you sell the property at capital gains rates. There's already a 10 to 15% arbitrage in your favor. Okay. So
wait, say that one more time, Kim. Repeat that for me.
When you take the benefits from the cost seg study, you're offsetting your ordinary tax rates, right? Your highest tax rate.
Yeah,
when you sell the property, you're paying it back at capital gains rates, which is 10 to 20 to 25%, depending on your structure. So as if you're at a 35% tax bracket, you are already at a 10 to 15% arbitrage in your favor just by doing the cost seg study. And then, of course, there's other things that play into that. Also, think of bonus depreciation as kind of it's like an advance on a paycheck. Okay, so you're going to start your job and you're going to tell your boss, pay me 5 years up front, and you'll get paid 5 years. And what can you do with that money? You can invest that money and you can do all kinds of things to help you make more money. But then if you quit your job in year 2, you have to pay back 3 years of payments, right? You got to pay him back that money. Him or her, I don't want to be prejudiced, but so you pay back those funds. That's kind of what bonus depreciation is. It is prorated. And so there's things that you can do to kind of offset that recapture, not to mention doing a 1031 exchange. So there will be recapture, but there's so many ways to get out of recapture. I mean, obviously, one, Jonathan is here because of a 1031 exchange. You're not going to pay recapture if you do an exchange. But there's also other methods that you can use in lieu of a 1031 exchange that give you the same benefit. For instance, if you have a failed 1031 exchange, for instance, you don't meet the 45-day requirement or the 6 month to close and you've missed it. If you're still in the same tax year, you can actually sell that property, say in February, okay, or in that first year, in the same tax year. If you can buy the other property in the same tax year, you can actually do a cost seg study, use the bonus depreciation to offset your gain and your recapture on the sale of the property, and you're not kicking the can down the road like you would in a 1031 exchange. You're actually square with the IRS. Now, it doesn't work all the time, but it is a really good strategy that I've used personally, and it's very beneficial, especially in the event of a failed 1031 exchange.
Wow, that's powerful. I didn't even think of that. That's wow. Cool. Ray J asked, what's the cost for a 1031 exchange, Jonathan? And maybe, Jonathan, you can speak to the typical forward 1031 exchange and then reverse 1031 exchange.
Yeah, so a traditional forward exchange is when you sell your property and then you get, a subsequent time period, which is 180 days to reinvest the funds into replacement real estate. So that's called a traditional exchange, a forward exchange. Fees for those types of exchanges, at least with us, are very straightforward. It's a flat fee of $1,000, invoiced through escrow, covers what you're selling, covers what you're buying. Fees for a reverse exchange, which a reverse is going to be when you actually purchase the new property first, and then you have 180 days to sell your current property. Those are a bit more complex. The IRS has different rules and requirements for them. So it is the price for those is really dependent upon where the property is located and the value of the property. But just to kind of give you some perspective on it, reverse fees can range from anywhere from about $5,000 to $8,000, which may seem like a lot, but when you put it into perspective with the reverse, you're actually going to own both of those properties at the same time until you get the relinquished property sold. So your equity will remain working for you constantly. Whereas with the forward exchange, you sell your property, the funds are basically parked in an escrow account with us, and it might take you 3, 4, 5, 6 months to get it reinvested. And during that time, you're not getting a return on those funds because you don't have it invested into real estate. So both options are great. It just boils down to, basically, really if you have the wherewithal to buy that new property first or not. If you do, a reverse exchange is great. Otherwise, we could look at that traditional forward exchange, sell your property, 180 days. Let's find something and buy it.
Awesome. And what's the smallest size property that still benefits from a cost seg, Kim?
So the smallest size is really whatever you have. If you have a basis of 50,000 or more, it's really kind of a no-brainer. I do want to tell you, I know we're at our time, but I want to just let you know that I am available for a few more minutes if we want to keep asking and answering questions. So whoever wants to stay, I'm able to do that.
Cool, thank you. We do have a few more questions. Participants are welcome to drop off, and we'll send out an email with the recording, like we mentioned in the slides. And thank you to Jonathan and Kim for going overtime. So Richard Hall asked, is there a difference in ability to use these strategies for business real estate versus investment real estate?
Yeah, so basically whether this is going to fall in your Schedule C or your Schedule E, it depends on whether you're a real estate professional or not, or if this is a passive investment. So there are different treatments for each. If you're a passive investor, then the benefits from the cost seg study will offset the income from that property. If you have multiple passive investments, you can group those together and actually use some of the losses on one to offset the gain on the other, or to offset the income on the other. So it really depends on the strategies. If you're a real estate professional, or classified as a real estate professional, then essentially all of this deduction will offset your W-2 or your ordinary income. Now, I've actually retired my husband a couple of years ago. He is our real estate professional. So now we actually invest in the real estate. We're using all of the deductions to offset my income, and we were able to use that and continue to build our wealth. So yes, there are different strategies for that, but it's still beneficial for both.
Yeah, what Kim just brought up is an extremely powerful strategy for people who are married or filing jointly in some capacity. I've advised a lot of clients where maybe one is a large breadwinner and the other one is raising the kids or working a part-time job. And if they can get a qualification as a real estate professional, then they can, get what's called active or uncapped, relatively uncapped losses. So instead of 25,000 a year of depreciation, they can get, you guys might know the number, maybe $1 million a year, or some much higher number.
40,000 if you're married filing jointly.
Yep. And if you're a real estate professional, then how much is the total depreciation limit that you can take? Is there one?
It depends on if you're going to fall under the 199A rules or not. So talk to your CPA. I mean, there are some things. I take excess losses. But if I was filing under the business deduction, then I would be limited to the 540. But my income is high, our cash flow is high. I need every deduction we get. So when I told you that we had, invested in pretty much every property type you can think of, a couple of years ago, I went and bought a gas station because it does have those special rules. And so we were able to offset about 1.6 million in income that year, just from that one particular purchase. So there are ways to strategize this, and it makes a huge difference when you can fall under specific strategies.
Fascinating. Amit was asking, can you do a cost segregation study on an ADU on your primary residence? So what I think he means is on his primary residence, if he
Yeah.
adds an ADU, can he do a cost seg study on that?
Yeah, if you have an ADU and it's actively being rented for profit, short-term rental, long-term rental, or whatnot, you can do a cost seg study on it. Essentially, we can do either one. If you built it, we do it based on the cost. If you purchased it, we'll extract the cost and do it just on that portion. But yes, you can do this on an ADU. You do not do a cost seg on a primary residence. But if the ADU is rentable and it's deductible, you're depreciating that asset because it's an income producing property, then yes.
Okay. And Ray J asked, what's the cost of doing a cost seg, let's say for a fourplex or a 15-unit building?
Yeah, it's relevant because our pricing is indicative of the property location, the property type, and the square footage. So I couldn't give you like a price right now, but I will tell you like a single family home is going to run about $3,000. Maybe multifamily might be somewhere in the neighborhood of $4,000 to $5,000. Maybe 6 or 7 if you're much bigger with a lot more square footage, and it really depends on a lot of different factors. So hopefully that helps. Please don't hold me to those numbers. Please.
That's
I hate it
helpful.
when people do that. Eric, you could probably answer that question better than I can because you've actually had those in that size.
Yeah, generally I ballpark, $4,000 to $5,000 per study, and Kim's great if you're doing multiple, properties. She's happy to give you a little bit of an additional discount. And then they do, it's important to note that they do basically a flat fee. So some other cost seg companies will actually charge you, they have to do a site visit, right? They have to see inside the units. They got to see what the light bulbs look like. So some other companies will actually charge you for flying out to the building and staying in a hotel and seeing the property. What I like about Kim's company is it's just a flat fee. Okay, so Sunny Dylan asked if he or she took cost segregation depreciation and their basis is higher now. The next property with 1031 needs to have the same or higher basis, meaning the building on that property. I don't quite understand the question. Sunny, if you'd like to unmute yourself, you're welcome to ask it.
So if he did a cost seg, I don't think his basis would be higher unless he did improvements. So I'm wondering about that part of it, Sunny. I don't know.
Maybe we'll do a one-on-one with Sunny afterwards.
Yeah.
Ramses Ortiz asked, what's the range of a cost seg study? I think we answered that roughly speaking.
Yeah.
Richard Hull asked, where is Congress at on reinstating 100% bonus?
Yeah, this is a great one. So we have been working on this for years, really literally. We've been working on this with Tax Cuts and Jobs Act, but also with the tax committee and the real estate roundtable. Right now, the 100% bonus depreciation has passed the House and it's sitting in the hands of the Senate. If it passes the Senate vote, then it will go for a signature to the president. We literally would have expected to have this a couple of weeks ago. There are some, pushback from some of the senators or congressmen rather that are, concerned about some of the other things that are in that bill. And so there is a little bit of a delay. So we're hoping to get that in the next couple of weeks. But that's where they are right now. So it has passed the House and we're just now waiting for it to pass the Senate.
Interesting. Okay. Ardrell Patrick asked, could a taxpayer depreciate a building, buy a profitable business, and not pay tax by applying the depreciation, assuming the new business is profitable?
It's possible you could do that. It just depends on how you're allocating all of those. My questions would be, is the building owned by the business or is it totally separate? Is the business renting it from a different entity? There's a lot of different varying parts on that, but it is absolutely possible. You could definitely use bonus depreciation or any kind of depreciation to offset business income, depending on how it's structured. Especially if you own the business and then you own the real estate, you could group those together. But again, it depends on if they're passive or active and how those activities fit into your tax return.
Yeah, and our Durrell Patrick, we'd be happy to schedule a one-on-one with you and answer in detail any questions. Dan Ross asked, can you move out of your primary home, rent it out for 2+ years, then sell using a 1031 exchange to put the equity towards an investment property? Jonathan, easy one for you. I think you're on mute. Let me unmute you there.
There we go.
There we go.
Yeah, absolutely. That's a slam dunk. You can definitely do that. The IRS absolutely allows interaction between those two tax codes, which is Section 121 and Section 1031. And they've allowed it since 2005. It was Rev Proc 2005-14. But basically, just as you noted, let's say you have a primary residence, you've been living there for years. If you move out of it, and let's say you then rent that property out for a year or two, sell it, then you take your $500,000 exclusion off the top. You do a 1031 exchange on the remaining balance. So let's say you sell a property for 2.5 million. You take your 500,000 off the top, you reinvest the remaining 2 million into another, rental or investment property. And that 500,000, you get to take full advantage of that, and you get to defer the rest of your gain by doing that exchange. So if it's a property that you've owned for a long time and you have gain in excess of 500,000, maybe you have $1 million gain, maybe more. Take that $500,000 exclusion, wipe it away, defer the rest of your gain by doing an exchange, reinvesting into some other real estate. Absolutely.
Awesome. Ray J asked, do you have to be a real estate agent or broker to be considered a real estate professional?
No. I think there are tons of classes out there on, how to utilize these types of strategies. I wouldn't listen to all of them. There are a select few that are really, really good, but, please don't get suckered onto these, Instagram, Facebook type groups, because they really are in it just for the money and they really don't know what they're talking about. And I will tell you that for a fact. Be very, very careful. But I will tell you, you do not have to be a real estate agent or have to be licensed as a real estate agent to be a real estate professional. Essentially, you have to prove that you have at least 750 hours a year in active management. So there is some requirements, but you don't have to have a license. So we probably own 40 properties or 40+ properties now, and my husband manages all of them. So he's obviously, a real estate professional because that's his full-time job, even though he's retired. I say he's retired, but he laughs. He's like, no, I'm not. But you do not have to be. I have my realtor license just because I do a lot of transactions anyways, and it helps me. But you do not have to have a license, to be a real estate professional. So just check into that, and I can help you with what the requirements are. Log your hours.
Awesome. Well, that was all the messages that have gone into the chat box. I'll give another couple seconds if anybody else wants to raise their hand and ask a question or drop one in the chat. But otherwise, we'll be sending out the recording and the information for how to contact us. We appreciate everybody taking their evening to join us for this call and learn a little bit about some sophisticated tax strategies. And we'd be happy to talk with you one-on-one about your situations and any questions that you might have. So with that, we'll wrap. Thank you very much, Kim, Jonathan, for your time this evening. And
Thank you
to
for
all
having
the
me.
participants that made that possible.
Thank you very much.
Yeah.
Thanks
night,
for
everyone.
having me.
All right, bye-bye.